what is a trade or business? And this is like the really important piece to understand. And this is like tax deductions 101. I assume most of you are not employed. That means that you get paid from a customer paying your business or paying you, right? That means you have a trade or business. If you're employed, if you're a full-time designer for some firm, none of this stuff applies to you because you don't have a trade or business. You have a job, two different things, right? So you must have an LLC, a corporation, or file as a sole proprietor with a Schedule C in order to do that. The most important section of the tax code you will ever need to learn is called Section 162 of the tax code. And I usually print this out and put my kids to sleep by reading this. It is pretty wonky tax stuff. It's not difficult to read, but it's just structured like a legal document, okay? I have summarized everything that's in this Section 162 in the next couple of slides, okay? But the tax code is what is the truth, is what tells you what can be deducted, what cannot. And if you're ever going to defend yourself in front of the IRS, you want to use tax code. You don't want to use some website where some person is suggesting some random thing, right? They're never going to use that. Tax code is what matters. But I'm going to summarize Section 162 of the tax code, okay? That section says the following, and this is great news for all entrepreneurs. All expenses that are ordinary, necessary, legal, reasonable, and paid or incurred while carrying a trade or business are deductible. Again, all expenses, ordinary, necessary, legal, reasonable, and paid or incurred while carrying a trade or business. I'm going to break down each of these so you know exactly what they mean, or at least what we think the IRS think that means, because that's also open to interpretation, especially something like the word reasonable, right? Many people are reasonable and unreasonable often about the exact same issue, right? All right. So what is a trade or business? So let's start with that. What is a trade or business? And a trade or business is income that's reported in a Schedule C. So if you're wondering whether you have a trade or business, just pull up your personal 1040 tax return that maybe your accountant did, maybe you did it in TurboTax, and see if you have a Schedule C, okay? So if you have a Schedule C, most likely because you receive a 1099 or you are self-reporting your business income, that means you have a trade or business. If you have an entity like an LLC or a corporation or a partnership, then you will probably be filing a separate tax return like an 1120, 1120S, and 1165. So a Schedule C on your personal return and any of these corporate returns means you have a trade or business. A trade or business does not come from investments. So if you trade in the stock market, if you trade Bitcoin or whatever, if real estate income, that's passive income, something that you get from a W-2 as an employee working at a company, that's not trade or business. So again, it needs to be business income. Now, what does ordinary mean? Remember, all expenses that are ordinary, necessary, reasonable, legal, and paid or incurred during a trade or business are deductible. So what does ordinary mean? Ordinary means that they are routinary. Like you see them and they happen very often, or at least with a certain cadence. They happen monthly, quarterly, yearly. And they're directly related to the business. The second one is the expense is appropriate and helpful to develop business activities. So there's two types of business activities you can develop. One is income generating and the other one is research and development. That's the only two. So marketing is income generating, right? Anything else that doesn't produce income is research and development, which is deductible. But as long as you can link that the expense drives to that and eventually turns into income, or the activity turns into income, you will be fine. That is ordinary. The second one is the third one is builds or maintains the reputation of the trade or business, not an expense that exclusively develops the reputation of the individual running or owning the business. This is the biggest problem, okay? So people that say, I need to wear Gucci suits and I need fancy haircuts because I need to look good, because my personal reputation is on the line when I perform this business, that is not deductible. Okay? There will be some exceptions to the rule if you're an actor or a model. Actors or models could, and I say could because some have and some haven't, could deduct some of those things. Because they're conducive to producing income. But anything that's to build or maintain reputation of the owner, of the individual, not the trade or business, would not be deductible. And that's where IRS draws the line on those quasi-personal vanity, what they call the vanity expenses. And also, in order for it to be ordinary, it cannot be a capital expenditure, because capital expenditures don't happen all the time. They're sort of one-time investments, like Ashley's build out of her studio, or a startup expense. Startup means it's pre-revenue. It happens before you make money. And we'll talk a little bit more about startup. There's special rules on startup. Next one in the rules was necessary. So it is required to be made in order to generate business. That means that you can prove that, look, I could not generate this piece of income if I didn't buy this. So if you're a graphic designer, Photoshop and a computer, it's required, right? Yeah. If you are a YouTuber and you make money from YouTube like I do, I need a camera, I need lights. It's necessary, right? I mean, they could argue that you don't need them to be as fancy, but as long as they are under the amount of income that I'm making, it's going to be completely okay. They can be directly linked to a business activity, and it cannot be personal in nature, or it cannot benefit the business owner with more than 50% of the total value and cost. So a classic example would be, just like we said, a suit, okay? A suit without a logo in it, without any embroidery, benefits the owner more than the business, because you need to be clothed, right? Otherwise you get arrested in the street if you walk around naked. So the ultimate benefit, or the majority of the benefit, you draw it personally. But if the clothing is logoed, so if you could take a fancy shirt or whatever and you put a logo in it, it automatically makes it not your benefit, is the business's benefit, because you're now a walking billboard for your business. So the value tilts to more than 50% towards the business. So that's kind of the rule that is used to figure out whether something is personal or business. And if it's tricky, if it's difficult to identify, just do the exercise to do the actual split, whether it's down the middle or 60-40 or whatever it is. Actually do an exercise to separate the two things. So this is where the car and the home office, these two are the trickiest ones. Well, actually, and meals and travel, right? So these four are the ones. Meals, because you have to eat anyway. Travel, because you're probably going to enjoy it. Home office, because it's in your home. And a vehicle, because you need to move around. So all these things have that quasi-personal, quasi-business that do not tilt 50% or more towards the business. Therefore, you need to manually split it or calculate the value to separate the personal part with the business part. Okay? Now, legal, this is an interesting one, right? Any bribes, okay, or illegal kickbacks, like you say, well, I'm doing business in Rwanda, and to do business in Rwanda, I got to wet some hands, okay? Well, that's not going to be deductible, right? Because a bribe or an illegal kickback in the US, conceptually, it's illegal. So that activity, it's illegal. That's not going to be deductible. The other one is having the legal capacity to generate income. So for example, if I do surgery illegally because I'm not a doctor, I cannot deduct my medical supplies to do my illegal surgery. Okay? So that's a really important point. For example, let's say I'm a drug dealer, right? Drug dealers in the US, by the way, I know we got some people that are not in the US. Drugs are federally illegal here. Marijuana is federally illegal. There are some states that allow you where you can buy marijuana legally, but federally, it's not legal. That means that if I'm a drug dealer, any office supplies I buy for my drug dealer operation is not deductible, right? The transportation is not deductible because I am doing illegal activities. I don't have the legal capacity to generate that income, which is interesting because marijuana businesses that are legal in certain states cannot deduct their office expenses. They cannot deduct any of their expenses with the exception of the actual crop, right? Because crop, even though the marijuana itself, selling marijuana is not legal, crops are from a farming perspective, they are cost of goods sold. Those are deductible. But marijuana businesses pay more taxes than everyone else because they cannot deduct any of these things. Okay? So if your business is illegal in nature, or you don't have the legal capacity or legal license to perform it, the associated expenses would not be deductible. Now we come to the really difficult one, which is reasonable. The actual tax code uses the word reasonable, which drives people insane, because that is a very subjective concept. So the only way I describe what reasonable means, it means it's not unreasonable. So it's a circular reference issue because there's no true definition to what reasonable means. There's a little tiny part of the tax code that refers to something else that talks about lavish or extravagant. And I have extrapolated that and made that the second definition for reasonable, which is not lavish or extravagant. So if you do Uber, your car will be deductible. But if you drive a Ferrari to do Uber, then it will not, because it's lavish or extravagant, and you probably draw more than 50% personal value for driving but not to mention it's a dumb business idea in the first place, but you will draw more personal value from a lavish or extravagant vehicle. And the last note I want to give you is, when you deal with an IRS auditor, you're dealing with a person. When you're dealing with a tax judge, you're dealing with a person. And they always think of themselves as reasonable. So it's whatever they think, unfortunately. Now, you can appeal and you can bring it up to more judges and that sort of thing, and you can bring more people involved. But it is what some people deem to as reasonable. Now, I'll give you a really good example. They teach this in tax college and that sort of thing, which is, there was a exotic dancer in the 80s. Her name was, I don't know. And her thing was that she got her boobs extended to an amount, like they were so big that she could make the claim that she had the biggest breasts out there. Therefore, she took all those surgeries, and these are surgeries to augment and surgeries to maintain, which I assume is a whole nother concept, right? And all special bras and stuff. She took all that stuff as deductions for years. She got audited. The IRS auditor said, that's not reasonable at all. That's not necessary. I mean, obviously, everything got taken away from her. She appealed it all the way to the highest federal court, and she won the case because the last lawyer that she used, tax lawyer, she said these are stage props. And the reason why they were able to still deduct those expenses, because every single advertising they had, come see Twin Peaks Jenny or whatever, right? Go see her. On the bottom always had some reference about her having the biggest, largest breasts out there. So because they used it as an advertising point, they could say this is a stage prop. Now, I know this is a crass example, but not the most G-rated type of example, but it's just a concept, right? Where you can start thinking that this is not all what one person thinks. Okay, I'm gonna find out what the real name is. Honestly, I don't remember, because I don't know anything about those topics. I'm married. I got 4 kids. I don't know anything about those topics. But I'm gonna find out the exact name just in case you want to read the tax case, because it's actually pretty interesting. All right, the next one is paid or incurred, and this would be a combination of things. One, was it paid during the tax year? That helps. So paid or incurred during the tax year helps a lot. Okay, this is what we call the matching principle. So the expense matches the income type of stuff. Okay, incurred means that you haven't paid it yet, or at least during the year, but you received an invoice and you're gonna pay it next year. But the service was performed or the product was delivered. So if you have a business that has a bill from a vendor in which you haven't paid them yet, but the service was performed during the year that you generated the income, or the product was delivered during the year, you can still deduct it even though you haven't paid it, because you can link it to that income. And this is what we call accrual basis accounting. And again, another huge rabbit hole if I wanted to just, explain what that is. But if you ever heard the expression cash basis, accrual basis, this is the stuff that they're talking about. Third point here, it needs to be documented. That means you need to have a receipt, an invoice, a timestamped email. a clear check, a voucher, a log, like a mileage log, right? Or a petty cash log, credit card statement, bank statement. Have something to document that the expense actually happened. The more documents you have, the more likely it is that you can get them deducted. All right, so I'm going to move on to special events and non-deductible expenditures because it matches with these sort of tax 101 topics, and then I'll open it for questions before we jump into a deep dive into home office expenses. So we talked about startup expenses. So these are all expenses made pre-revenue. So this is in development of future business. So generally, if a business is if an expense is a startup expense pre-revenue, the IRS will limit the startup expenses to $5,000 on that first year. And the balance gets amortized over 5 years. So if you spend $15,000 to get a business started, you can deduct 5 and then take the other 10 and divide it by 15. And that will give you, by 5. And that will give you the idea of how much you can take that. And the concept is IRS doesn't want you to take all the startup expenses and deduct them all the first year. Okay? Personal or non-deductible expenses. So any expenses which benefit the owner personally, again, in more than 50% of the value or cost, are usually deemed personal in nature, which means they're not deductible. If the business and personal value, so if you can split off the expense and it could be easily calculated, then you should split it with the proportion and only take the business portion. Okay? Just like we do with the home office. Classic example, as we mentioned, vehicles, meals, travel, and home office. Big question I have is shareholder distribution. So you have an LLC, I have an S corporation, and I want to pay myself as a business owner some cash, right, for services rendered as the owner of the business. That is typically not taxable. But it's also not deductible. So you take away $5,000 to pay yourself to feed your family. You will not pay taxes on that, but it will also not be a deduction. So basically, it's a net effect of 0 to your profitability. Now, there are some cases in which a taxable distribution could be taxable. It depends if you have a C corporation, if you're taking out a dividend, or if you're taking money in excess of your capital. That stuff gets pretty wonky. I can answer them during the Q&A, but that's generally speaking, distributions in an LLC or an S corporation, they're not going to be a taxable event, but also not a deduction. Okay. I have many clients that say, hey, what about the $100,000 I paid myself? Isn't that a deduction to the business? And I said, no, but it's also not income for you, right? Or not additional income anyway. Charitable and political contributions. So charitable contributions are typically not deductible through the business. Now, they might be deductible on the personal tax return, but there's a threshold, right, to how much you would have to pay in charitable contributions in order for it to even matter when it comes to deduction. So your business could give charity all day long, but don't expect it to be one-to-one a deduction through the business. That's kind of the lesson. So bottom line, don't give any charitable contribution unless you're willing to give it without the tax deduction. Okay, tax deduction is nice. We call that gravy, but don't do it as a tax planning event. Political contributions are never deductible. Thank God, right? So you want to give money to whomever, you can do it, but you cannot take a tax deduction for it. As a taxpayer, I don't want to fund political contributions. So I agree very much with this concept. Lobbying expenses are not deductible. So if you pay a lobbying company because it's going to help you with your business or whatever, that's not going to be deductible. However, if you pay into an association, like for example, I pay an association called the AICPA, which is the Association of Professional Accountants, and they lobby CPA related stuff to the government. So their activities, they're non-profit anyway, but just because they lobby doesn't make my contribution to AICPA not deductible. It is. You just can't pay the lobby directly. Okay? Fines and penalties. In general, if you're making a payment that is a fine or a penalty because of lack of compliance, that's not deductible. So for example, if you get a speeding ticket, that speeding ticket is not a transportation expense or an auto expense because you are paying that penalty because you committed an infraction, because you did something that was illegal. So anything that's, again, lack of compliance, you did something illegal, you're getting fined, that's never going to be deductible. You can pay it through the business, but it'll get reclassified as a distribution or a personal expense, as we talked about earlier. Gifts. So listen to me. Businesses cannot gift people money, cannot gift assets to people. There's no such thing as a business gifting. A business is in the business of conducting business, not gifting. Now, there's such a thing as a business gift where you give a client a gift card for referring you another client, or you buy them some coffee or some flowers or whatever. You can do that. You can do business gifts, but it cannot exceed more than $25 per person per year. Okay, so if it's classified as a business gift, quote unquote, the maximum benefit is $25 per person per year. Bottom line, IRS doesn't like business gifts. Okay, but they allow you to take some because they assume, yeah, someone can get a gift card here once in a while, $25 worth. Now, another really important one is if you have employees. I don't know if any of you actually have employees. You cannot gift your employee a bonus or just gift them money. If you have an employee, that money must go through payroll and it must be taxed through payroll. That's probably one of the biggest infractions that small business owners take. Last one here, I think it's the last one on the list, is capital losses. This is when you sell in an asset at a loss. So for example, I buy a computer which cost me $5,000 and I'm obviously never going to make money on selling a computer. I'll sell it in the future, let's say for $1,000. So that in your mind, you lost $4,000. In the reality, you did lose $4,000. Okay. So if you sell an asset as a loss, you can take the deduction, but most of the time it's going to be a capital loss, which has certain deductions, it has certain limitations. So it's not a one-to-one deduction. You might have a limit of $1,500 or $3,000 a year. You can take at a capital loss. That's a really important one. And depending on the type of asset and that sort of thing, like real estate is a classic example. If you lose money on a real estate transaction, you cannot take the entire deduction the entire year. If you lose money on on the stock market, you cannot take the entire deduction on the year unless you're offsetting other capital gains that match the same asset type. All right, so let's get started with the famous or the infamous red flags. So these are, I would say, my top 9 areas that I would tell, especially service providers, to be aware of, to be careful about when it comes to including or excluding this information on the tax return. Number 1, unreported income would be the biggest one. So I've done several IRS audits, and what the IRS is looking at all the cash and all the money that was deposited in the bank account, both personal and business, and they're trying to match it with whatever was put on the tax return as income. And then it will be your burden as a taxpayer to prove that those deposits are not in fact income, that there's something else like your own money or a loan from someone, that sort of thing. So any deposits that come into your bank, make sure you're aware those are auditable, and the IRS is going to want to tie those in with whatever is in your tax return. The one that's the biggest one is an unreported income from a 1099 form. So some of us are independent contractors, and the business and the businesses that we work with pay us to our personal names. Therefore, they give us a 1099 form, which is what gets reported to the IRS to let them know that you received business income. Now, there's different types of 1099 forms. There are 1099 forms that get given to your business, assuming you are incorporated. There are 1099 forms given to you personally, assuming you're not incorporated, or the business that's paying you has your Social Security and your personal information. They don't have your business information, so they'll give it to you directly. Also, payment providers like Stripe and PayPal and any digital electronic payment providers, if you're registered as a U.S. person and the account is under your personal name, they're going to give you a 1099-K to your personal name, equaling every single payment that you process through there. Now, if you have a PayPal account or a merchant account and you have a business, make sure they're reporting that stuff to your business, not to you personally. This is where the most area of confusion gets. People get started, they set up the merchant account under their personal name, they incorporate later, 2 years later or whatever. They forget to go back to PayPal or Stripe or whatever to change it to the new corporate information, and then they keep reporting that income to your personal name. That's going to screw up with your tax return, probably trigger an audit. Second one is the home office. So your home office, so claiming office space in your home or space in your garage for storage or space, for you to have a studio or whatever, claiming that as a business expense is conducive to an audit. Now, it doesn't mean that there's something wrong with it. If you legitimately have home office or dedicated business space, a garage for storage, whatever, if you legitimately have that, then you can take the deduction for that. And we're going to have a spreadsheet that I'm going to show you how you can break out all the expenses related to home office. This is the biggest one I've had questions on during 2020 because of the pandemic. It's pretty much obvious why this one's the biggest one that people are asking about, right? Many people used to go work in an office or in a WeWork or at the client's office or in a Starbucks or whatever, and they never felt the need to invest in a home office. And now they're physically separating space in their house to work. Now, I know a lot of entrepreneurs and a lot of people that were being contractors and a lot of freelancers already had some sort of home office setup. Now, vehicle expense is the third biggest one. The biggest issue is when the business, the vehicle is not owned by the business, is owned by you personally, but you take it as a business expenditure. You can do that, but you have to keep a mile log. And most people don't keep a miles log. So they just guesstimate and tell their accountant, 3,000 miles a month I use my vehicle, and they go pretty high on the vehicle expenses, and that becomes an issue. There are two ways to claim vehicle expenses. You can do mileage, which is about 57 cents per mile, or two, you can do what's called actual expenses, which is a similar formula to the home office formula. It to be one of those areas that get mostly audited. The next one is travel expenses, and the biggest red flag in travel is when you travel with your family. Now, I gotta tell you, I travel with the family for work a lot, right? So for example, I'll go to a conference in New York and I want to deduct my plane ticket and I want to deduct a portion of the hotel because I am working while I'm traveling. But my families, my kids, my wife, travel wouldn't be deductible because they're not part of the business. The biggest mistake that small business owners, entrepreneurs, and freelancers make is that they buy all their tickets in one shot. And that makes sense, right? You make the reservations, you want to sit everybody together, so you buy all the tickets in one shot. The problem is it is not conducive to helping you separate those expenses. So what I recommend is if you are going to travel with the family and it is a business travel that you're combining, that you actually book your plane ticket separate than your family's. That way it's easy to identify in the accounting. Even better, use the business account for buying yours and the personal account for buying your family's. Hotels a little bit more tricky. What I do is I pay the whole hotel and the transportation with my business card, my business account, and then I take away the proportion for the family. I just do it per head. So if it's a 4-person family and I'm the only one doing business stuff, I only take 25% of those expenses when I'm combining a family trip. For the most part, if you're not combining a family trip, all travel expenses will be deductible, not an issue. The next one is it's called business meals, and most people know it as meals and entertainment because that has existed for many, many years as that name. And the biggest red flag here is not eating with a customer or with a business associate. So you went to McDonald's to have lunch and you paid it with the business and you want to deduct it. Well, that's not a business meal because you're not doing business dealings at McDonald's. You're not closing deals at McDonald's or whatever, right? So you want to deduct any meals where you go with your client to talk about business, to close a deal, to discuss a relationship or a partnership. And you want to deduct, for the most part, only the meals portion, not the alcohol portion. Now, if the alcohol is what they call social drinking, so you're eating a meal with wine, that's okay. But if you're having some appetizers and then having 2 bottles of scotch after, where the check itself, 90% of it is alcohol and 10% is food, then that's going to be an issue, because typically alcohol, even though it's a great social lubricant, is not conducive to business dealings. Same thing as going to a strip club or going to a loud bar. It's very difficult, and this happens a lot, unfortunately, but for the business owner to make the case that you had an actual serious business conversation in a place that is not conducive to business dealings. So pick your battles there. Pick the restaurants where you can show more or less who you ate with and what kind of business you did afterwards. Remember, all audits are retroactive. So if you get audited today, you're probably going to get audited for 2 to 3 years ago. So you said, oh, I ate with so-and-so 2 years ago. You had 2 years to do business with that person. If the IRS sees a pattern that you're saying, I'm eating with all these prospects, right? And you did business with no one, they can disallow those meals, those meal expenses. And if the expense is purely entertainment, and it doesn't include meals, it's not deductible at all. The next one is contractor payments. This is very typical when you pay somebody to help you with the deal, with the job, someone that's not necessarily an employee. They are a subcontractor, they are a contractor, and then you pay them, you write them a check. You write them a check to John Doe, and then you don't issue a 1099 for that payment, or you pay them via Venmo or Zelle. Like you pay them with some digital format, and you don't give them a 1099. If in the IRS you're paying individuals, name and last name, John Doe, and you're not letting the IRS know, and they're American, they have to be a U.S. person. If they're non-U.S. person, it doesn't matter. Just keep records of the fact that they're a non-U.S. person. Keep a copy of their invoice, a copy of the passport would be best. I know that one's a little bit harder to get, but if you can get a copy of somebody's passport, a copy of their invoice that clearly states they're doing the work overseas, then you're going to be okay. But if you pay a U.S. person, you got to make sure you give that person a 1099 at the end of the year. Otherwise, the IRS could disallow those contractor payments. The seventh one is expenses paid in cash. Anything in general that's lacking a paper trail, it's going to have an issue. Now, typically for very casual things while traveling, you could get away with some annual daily per diems, where as long as you're spending less than a certain dollar amount, and we can talk about per diems if you want to in the Q&A section, but less than a dollar amount and each expenditure is under $75, the IRS is more lenient towards those expenses paid in cash. But if you have this important expense that you always pay in cash, you got to have some sort of paper trail to be able to prove that. The eighth one is a capital asset as an expense. That's when you buy a big thing. When you buy a car and you deduct the whole thing, or you buy a $5,000 computer system and you have not that much income to deduct the whole thing the whole year. So the IRS is going to want you to depreciate that over time, only take part of those expenses. And the biggest one, the last one, is a hobby loss. Basically, if the IRS deems that your business is not a business, they disallow every single expense because they recategorize your quote-unquote business as a hobby. So I'm going to give you a typical example. I had a client who started a YouTube channel. He built out a whole studio in one of his rooms and started doing videos. Great videos, beautiful videos, never monetized, never drew an ounce of income from it, never quit his job to start his own business or an LLC or a corporation, always had a full-time job, just kept doing videos and videos and videos in the home studio, spent maybe $5,000 to $6,000 between camera and doing the home studio. And he took out the deduction, right, in a Schedule C form, as a YouTuber per se, as a person doing media, and never took any sort of income. 3 years later, they got audited. There was, they quit the activity, never had any income from that activity. The IRS deemed it as a hobby. We could not defend it no matter what angle we put, because that person never had $1 of business income. And unfortunately, that's, you have a couple years after to kind of prove that. Again, all audits are retroactive. So he had 2 years to make money. And I had warned him, and he's kind of okay with it. The penalty wasn't that bad. But that's the point. The point is, if you don't have a business, the IRS says it's a hobby, they don't have to allow the deduction. All right, I'll stop it there for questions.